Too young to be terrible every day. Too young to be terrible every day. All right, guys, so what we're going to do today is we are going to take a look at some additional questions about investments. I think it's really important. I want you to get comfortable looking at financial statements. We've been looking at Target for every chapter last semester and this semester, but we're gonna take a little bit of a detour, and we're gonna take a look at CVS today. You guys did the case assignment that I gave you the other day, and I asked you a question about Target, and for the most part, the answer was no, they don't have investments. Some of you did find some government stuff. That's okay. It's really not what I was referring to, but it's all good. I was referring to basically, investments in other companies. And so Target basically doesn't have those, right? But if you take a look at this case here, what I want you guys to do is you're going to go to the CVS financial statements with me. We're going to answer these questions together. There's no place for you to upload them. I just want you to see what it looks like. So we have an opportunity to view it in a financial statement. So it says, if you read in the paragraph, Target does not have investments in stocks or bonds. However, CVS Health Corp, everybody knows what CVS is, right? CVS Pharmacy, yes, okay. Which purchased Target's pharmacy and clinical business during 2015. So I don't know if you knew that. They do have some investments, so we're going to look at those. So I'd like you to go to CVS's 2019 10K. You can go to cvshealth.com, or you can do what I did, and I just Googled it. And basically what you get when you Google it is you get this here. You click on the 2019 annual report, or anything that says annual report, and you can see the most recent report is 2022. And if you scroll down just a little bit, you'll see the 2019 annual report, and right underneath it is a link to download the PDF. So you want the PDF, which I have open in the tab next to it. I'll show it to you momentarily. But I'm just going to answer a few questions. Just want you guys to get comfortable looking at that too. When you download the PDF, it's going to look like this, okay? And you're going to help me answer these questions. And I'll show you the questions again while you're looking through the PDF. I'm going to give you some directions so we're not here all day. Because, look how it's almost 200 pages long. And the questions do kind of give you some tips on what notes to look at. But even within the notes, there's kind of a lot of information. And I don't want to spend too much time on this today, but I do want to look at it. Okay. Do most of you have the 2019 annual report up? We good? All right, so let me go back here real quick just for a second to the question. The first question, it says, regarding CVS's investments in debt securities. So very specifically, the first question, all A, B, C, and D, all pertain to debt securities. So let's remember what debt securities are, right? We buy other companies' bonds. We classify them as one of three. What are those classifications for debts? Held to maturity, available for sale, trading. Yeah, so those are our three different categories. Great. So letter A says, turn to note 1, significant accounting policies. I'm going to show you guys how to find that you might already found it, but I'll show you how to find it quickly. What approach is CVS using to account for its investments in debt securities? Are they HTM, held to maturity, TS, trading securities, or AFS, available for sale securities? All right, so, you can obviously do this a couple of different ways, but if you kind of skim through the beginning of the annual report, it's a little fancy, right? Like highlights. So for the average person who might not know what they're looking at, this is kind of in layman's terms, a lot of this information. We know what we're looking at this point, right? So as we page down to the actual 10K itself, it starts to look a lot less fun, doesn't it? Oh, yeah, we're not looking at it. Okay, there we go. It starts to look a lot less, serious, I guess, right? So if you go to the table of contents, you can actually jump directly to item 8, financial statements and supplementary data. That is where we're going to find the answers to our questions. Within item 8, there are additional links. So if you scroll down to notes to consolidated financial statements there, you click on that, that's page 97. Everybody able to do that? So that's page 97 of the actual document, but it's page 109 of the PDF, so be careful there, right? And I'll give you a tip here. It starts off, talking about a description of the business. That's what note 1 always starts off with, but then a significant accounting policies. And you kind of think about it, it kind of just talks you through how things are done at CVS. Particularly on page 99, you can find the section on investments. And I'm going to pause there. You need to answer the question, what approach is CVS using to account for its investments? Are they HTM, TS, or AFS? So as you skim through those first couple of paragraphs, whoever has the answer first can tell me. Matt. They're available for sale. And where do you see that? Yeah, right here it says, debt securities are classified as available for sale and are carried at what? Fair value. Then it says, see note 4, fair value for additional information. So this lines up right with all the journal entries that we did in chapter 12, right? This lines right up with those. Obviously this first part is just about debt securities, but right down here you can see equity securities follow, which question number 2 does ask some things about equity securities, but that's where we find the information. So page 99 of that first note, CVS classifies investments as available for sale, which means that they're not actively trading them, which we wouldn't expect them to because they're not a bank or a financial institution. And held to maturity would mean they were holding them till that date, right? That maturity date. Everybody okay with that first one? Any questions? All right, next. You guys are going to find this for me. It says turn to note number 3, investments. What is the total amount of CVS's investments as of 12/31/2019, and where are those investments shown on the balance sheet? And when it says where on the balance sheet, those are assets, but you want to tell me the category of assets. So I'm going to give you guys a couple of minutes. You can talk amongst yourselves if you need to, but I want some numbers. Somebody throw some numbers out for me. You got to go to the note 3. Note 1 was on page 99. Note 3 is down a little ways. Again, you guys can talk amongst yourselves if you're not sure. Your neighbor looks like they're getting the answer. Help a fellow classmate out, folks. The hardest part is actually finding the information, reading through all this stuff. It's a lot of information. Investments. You guys find the note on investments? Note number 2 is kind of long. So, yeah. Page what, Ashton?
No idea.
Oh.
119.
119 of the document. Yeah, not of the PDF. 119 of the financial statement part. So be careful there. And it starts out, and the title of note number 3 is what? Investments. How about that? So again, the question is, what are the total of CVS's investments? And then how are they reported? Are we ready to look at it together? Highlighter, I circle this right here. Right? Everybody found this? If you didn't, I want you to. You need to know how to find these things. So you've got debt securities available for sale. It tells you right there what they are, right? They're not the only securities. They're not the only debts, excuse me. They've got mortgage loans and other investments. So we're interested in the total. The question asks the total. So what's the total?
19,687.
Yeah, I was hoping somebody would read it to me that way. And how do you know it's billion? Because right here it says this is in millions, right? So $19,687,000,000 of debt. You think, yikes, right? How is it reported? It also tells you that here too. 2,373,000,000 is what? Current. And 17,314,000,000 is long term. That's how we answer that question. Why is that important? Does anyone know? I don't know that we will talk more about that as we get into this next group of chapters. It's all about liabilities. Why do you think it's really important? Like, they've got a lot more long-term debt than they do current debt. Why is that important?
Would it change your current working capital?
It does. It impacts several really key ratios, one of those being working capital, which is, can you describe working capital?
Current assets minus current liabilities.
Current assets minus current liabilities. So the fewer current liabilities you have, the better your working capital ratio is going to be, right? And it's kind of like the long-term stuff is going to come up eventually, but not currently, right? If it's long-term. It's kind of like this. Here's an example. So some of you guys are sophomores, right? I know some of you are juniors. Maybe, I don't think there are any seniors in here, but if you're a sophomore or junior and you have a student loan, it's not a current liability because you don't have to start paying back your student loan until 6 months after you graduate, right? And so if you were to go today, let's say you have a job and you think you make enough money from your job to buy a car, a used car. If you were to go to the bank and you were to fill out an application, would you include your student loan? No, you would not. It's not a current liability. It's not even a debt yet that is sitting there waiting for you, expecting it to be paid. So it wouldn't be calculated. It's not a part of your current debt, right? So that's why that's important, because if it was, could you afford a car? Maybe not, right? Maybe not at the current income you might be earning as a student, because you're not working a full-time job, or you're working a full-time job, but not a full-time job in the field in which you're getting a degree in. You see what I'm saying? So, and we'll talk more about the classification of debt in chapter 13, but I wanted to mention it as we looked at that. Okay, so that's that question. Let's jump over to part C. What is the total amount of CVS's debt investments that are classified as available for sale? And how much of the total is amortized cost as opposed to accumulated fair value adjustment for unrealized gains and losses? That one's a little harder. So let's go back here together. Let's look at that. And I'm going to have you guys scroll down a couple of pages. So jump down to page 121 with me. Here. And this might have taken you a little longer to find, but of course I did this in advance so that we have this issue. And if I was just like randomly pulling this up and looking for this, it would take me a while to find too. I mean, you look for certain keywords and things like that, but no two financial statements are going to be identical. So it says the amortized cost and fair value. That's what the question's asking about. That's why I know this is the part of debt securities. So those are the securities available for sale. Are shown by contractual maturity. So they're talking about like when they're due to be paid back, right? Actual maturities may differ, blah, blah, blah. Okay, here's the amortized cost, right? So the amortized cost is $15,898,000,000. And here's your fair value, $16,922,000,000. And you know, right, that we've got to report those at fair value, right? Remember from your exam? Yeah, those were on your exam, right? And where does the fair value adjustment get recorded? What part of net income? OCI, which stands for Other Comprehensive Income, right? So the adjustment to fair value, what's the difference there? $1 million, what is that? $1 million, or 1 billion, I'm sorry, 1,024,000,000, right? All right, questions? Everybody able to find that on their 10K? All right, and then lastly, for this question anyway, it says, turn to note number 4, fair value. This one's something we didn't talk about in class, so I'm glad it came up here. What is the amount of CVS's investments in debt securities that is categorized at level 1, level 2, and level 3 of the fair value hierarchy? We've not discussed that, right? So in our examples of adjusting investments to fair value, where did I tell you we got our information for fair value? Yeah, like the Wall Street Journal, the financial market, right? I mean, I just said it's just whatever we saw on the stock market, right? Or the Wall Street Journal is a great resource, right? There are other sources, though. Some of them are more reliable. Some of them are more subjective than objective. So when we're talking about these tiers, we're talking about that subjectivity and how these fair values are determined. So if you scroll down to page 126, I'm going to show this here to you while you look at it. 126 of the document, of the actual financial statements, not of the entire PDF. There we go, 126. At the top, is this where I find it? Yeah, at this paragraph here, nope, hold on. 125, sorry. It says the company also values certain debt securities using what? Level 3 inputs. Up here it talks about level 2 and level 1, right? So this is the area, I guess I need to scroll up a little farther. This is the area where it explains those. And we're going to look, after we look at, there we go, debt securities, page 125 to 126. So where quoted prices are available in an active market, the Wall Street Journal, the financial news, the ticker, right? Debt securities are classified in level 1. Why do you suppose those are level 1? Like why they're the top of the tier? You think of level 1 as being the best. Because they're the most what? Well, the most reliable, they're the most accurate, aren't they? I mean, yeah, right? Companies' level 1 debt securities consist primarily of U.S. Treasury securities, so those are government securities. Level 2 debts are obtained using models, matrix pricing, which does use quoted market prices of debt securities with similar characteristics, or discounted cash flows to estimate fair value. The company reviews these prices to ensure they are based on observable market inputs that include quoted prices for similar assets in active markets, quoted prices for identical assets in inactive markets, and inputs that are observable that are not prices, such as interest rates and credit risks. So you got a little bit more going into this level, and perhaps not, I mean, and I'm not saying it's subjective, it's not, it's objective, but it may be subject to some subjectivity, right? And then it goes on to talk a little bit about that, and then it says level 3 inputs, fair values are determined by outside brokers, or in the case of certain private placement securities, priced internally, where there's lots of subjectivity probably, right? And so that's important to know, okay? So when you scroll down a little bit more, you'll see how CVS's debts that we were talking about, okay, can you guys look up here? The total $16,922,000,000, that was the total we saw that was adjusted to fair value, correct? Right? And then here you have the breakdown, here's your level 1s, level 2s, and level 3s. And the majority of the debt falls in level 2, which I would expect it to. I don't really know a lot about all that stuff that I just read to you in terms of like, it's not my area of expertise, that's more of a finance thing, right? But I do know that most of them should belong in a level 2, right? And that's how they're broken down. And then they also do the same with equity securities, which we haven't gotten to that question yet. We are going to momentarily, but kind of the same idea behind it, right? Really kind of referring to the subjectivity, the objectivity of those fair values. Where are you getting them and how reliable are they? All right, you with me? Okay, back to the last question here. We're almost done. So, per note 1, CVS has equity method investments in SureScripts LLC and in Heartland Healthcare Services. CVS indicates that these investments are immaterial for the year ended December 31, 2019. So I'm going to go back up to note 1. You can see exactly what that says because I don't remember. I read it this morning. I don't even remember. You should go there too with me to note 1. Instead of just sitting there like, bumps on a log. And it doesn't have a lot to say about them, does it? Equity securities with readily available fair values are measured at fair value. How about that? With changes in fair value recognized in net income. Just like we learned on Tuesday, that's how they're reported. All unrealized gains and losses get reported in net income immediately at the end of the year, right? So then the last question that's being asked here, it says, how would Heartland's earnings affect? Now, well, let me back up. What do you suppose immaterial means?
Negligible, doesn't really matter.
Can you kind of relate it to something I talked about on, you're not necessarily wrong, but can you relate it to something that we discussed specifically about the different kinds of, the accounting treatment based on something in particular for equity securities? I taught you 2 methods. Significance. Yeah, so that's what they're referring to here. We talked about significant influence, right? You guys remember that? Everybody remember what was a firm that didn't have significant influence? How much did we own of their stock? Less than 20%. If we had significant influence, then we assumed we owned 20 to 50. Okay, and over 50 was consolidation, which we didn't do, right? This is a way of saying these investments are immaterial, no significant influence. That's what it means. Okay? Different language than the textbook. I get that. See, that's why I want to show this to you. But that's exactly what it means. So, the 2 questions basically say, tell me, what account would be impacted? How would Heartland's earnings affect CBS's income statement? So, if you go back to exercise 19, maybe from chapter 12 that we did the other day, you guys have that in your notes? Look at that exercise. I didn't bring it with me, so you're going to have to look at it for me. Look at exercise 19, and part 2 of that exercise, well, part 1 and part 2, right? We compared them. We did no significant influence versus significant influence, right? Okay. And so look at the journal entries where there was no significant influence, correct? Tell me how earnings would affect CBS's income statement. If there's no significant influence, what did we say? It wouldn't. That's exactly right. What if they did have significant influence? Then we would do what?
Debit, investment.
Yeah, we would increase the investment account, right? And credit a revenue account. Yeah. Right? See where I'm going at with that? See where I'm going with that, I mean. And then how would earnings affect the balance sheet? Well, okay, I answered that. I answered both those questions. The debit to the investment account would increase the investment account in the balance sheet. The credit to revenue would increase revenues on the income statement if there was significant influence, right? If there's no significant influence, then there is no impact. So assuming that immaterial blah, 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 blah. The investments are immaterial, but it says assuming that the investments are material. So I wanted to answer both, right? Immaterial, you got to look at those first journal entries, right? There's no impact. If it's immaterial, there's no impact on the income statement or the balance sheet with regards to net income. If it's material though, so again, immaterial means no significant influence here. Material means significant influence. So you're just looking at that one journal entry, right, for net income. No significant influence, neither the income statement nor the balance sheet is impacted. Significant influence, you've got an increase in the investment account and the asset section of the balance sheet. You've got an increase in revenues on the income statement. Okay? And again, I always like to, if I can, I want to make sure that we can kind of line this up with things that are, this stuff is real. I'm not sitting up here talking to you about stuff, that doesn't happen in everyday real life. All right, you guys have any questions about that? Again, this one you didn't have to turn in or anything like that. I just wanted to go over those questions with you. All right, so next chapter is chapter 13. So we're focusing now We really focused on assets up through chapter 12, in case you didn't realize that. All last semester, we focused on assets. In a perfect world, I would have got through all assets in one semester, but it's not a perfect world, and that would have been too fast, and so we didn't. So now, that's why I gave you an exam after chapter 12, because this is now, we're going to start talking about the other side of the balance sheet, where lots of interesting things happen, right? So this chapter, I am going to kind of blow through this chapter pretty quickly, and I'm going to tell you why, because this is all review for the most part. And you say, well, I don't remember any of this. Well, you have PowerPoints with notes. You have a textbook you can read. I did post an agenda. We're not going to get through all of chapter 13 today, but I will finish it up on Tuesday, and then you'll be responsible for whatever's left, because, again, this information is not new to you. All right. So current liabilities. When I'm talking about current liabilities, what am I talking about? We have current liabilities and long-term liabilities have their own chapters. So this is all strictly just current liabilities, which means these are obligations that are due within a year or less, right? Okay? Yes. All right. So, and we'll talk about contingencies too. Who remembers what a contingency is? What does the word contingent mean? Dependent upon, right? So contingencies are liabilities that might happen if something else happens. Got it? Yeah, okay. So, definition of a liability. This is identical to the definition that's in your financial accounting textbook, chapter 9. Identical, right? Liabilities are probable. What's probable mean? Likely to happen, right? Probable future sacrifices of economic benefits. What are you usually sacrificing with debt? Cash in the future, right? You gotta pay your bill in the future. They arise from present obligations, right? And they usually result from past transactions or events. If you went shopping last weekend and you used a credit card to buy your groceries or whatever it was you bought, does that meet the definition of a liability? Your credit card transaction. It most certainly does. It is a probable future sacrifice of economic benefits. You're going to get a bill in the mail and you're going to be expected to pay the bill with cash. It is a present obligation. You typically have 25 to 30 days to pay your credit card bill. It's called a grace period, right? And it results from your past transactions or events. You went shopping last weekend, right? It is pretty straightforward. That's really the definition. Current liabilities. Again, we already talked about what that basically means, right? These are obligations that are payable within a year. We satisfy them with current assets, usually cash, or this might be a new one, a creation of other current liabilities. Can I use a credit card to pay off a credit card? I can. Do I recommend using a credit card to pay off a credit card?
No.
I do not. Right?
Yes.
No. Garrett, don't say yes.
No, I said someone else did.
Oh, don't say yes. That would not be a good answer. I know what some of you are thinking with your little, I don't know what kind of mind I want to call it. I was going to say twisted. It's not necessarily twisted. Creative minds. Creative minds. All right, so these are some current liabilities that you've already done journal entries for back in Accounting 101. Accounts payable, notes payable. Commercial payable is similar to notes payable. Income tax liabilities, dividends payable, and accrued liabilities. Accrued liabilities like deferred revenues. You guys remember deferred revenues? Who remembers what a deferred revenue is?
Somebody paid you for a service you didn't provide.
Somebody pays me in advance for a service I've yet to provide. If you're in my Accounting 101, I always used the lawn care. You guys, you're going away on vacation and you want me to cut your grass while you're gone. And since we're talking before you leave, you're going to give me $50 to do it, right? Can I call that $50 revenue? No, I didn't do anything yet. I didn't cut your grass yet. You give me the $50 before I provide the service, I actually owe you something, hence the term accrued liability, right? Not that we've had this conversation, but liabilities are recorded at their present values, what they're currently worth in today's money, okay? All right, and let's take a look at a couple examples, specifically accounts payable and trade notes payable. So in other words, we're looking at the difference between accounts payable and notes payable. And here's what I always, accounts payable are liabilities that arise in the normal course of business. They're all about granting somebody a grace period to make a payment. So when I say a grace period, I'm talking about your credit card. Your credit card is not meant to be a tool for a loan. It really is not. Even though I know you can borrow money against your credit card, I wouldn't recommend it for lots of reasons, but we won't get into that. But the idea behind a credit card is to just grant somebody a grace period, 25 to 30 days to make a payment. The idea behind extending credit to a customer or having credit extended to you is the courtesy of taking whatever that is that you bought. Maybe it's inventory, putting it in your store and selling it so that you get the cash to pay back the bill, right? Like I use this example all the time. If I want to open a shoe store and I want to start selling shoes, I cannot make revenues until I first buy what? Shoes to put in my store. Where am I going to get the money for that? I might have some money to buy some shoes, but I'd like to use my sales to buy more shoes, right? But it's like putting the cart before the horse kind of a thing. And that's exactly what we're doing. It's not a loan. It's giving somebody 25 to 30 days to sell some stuff, to provide some services, to take the cash from that, and then to pay your debt. Okay, so please understand that. An accounts payable is intended to have a short duration, less than 30 days, which is why there's typically no interest attached to a notes payable. There might be, and they're referred to as non-interest bearing, because when we talk about accounts payable, we never say at 6% interest or 8% interest, right? We say due in 30 days. You pay it within 30 days, no interest. There may be a finance charge if you don't pay it within 30 days, but it's not interest like a loan. The word note, I tell you guys, means what? Old people, that's me. Use that term now, use that term. Note, I gotta pay my bank note. It's a very common term from people from the 20s, 30s, 40s, 50s, 60s, I guess 70s. It's a loan. I gotta pay my bank note. It means I gotta pay the loan that I have through the bank. That's what people say. My grandparents said that. They didn't like debt. Those folks back in those days, they didn't like debt. But a note is a loan. And when you go and you use your credit card and you sign, why are you signing? It's not a promise of payment. That's what I was hoping someone would say. It is not a promise of payment.
So that you actually agree.
Nope. What's it say under, does anybody have a credit card on them? Look at underneath the signature. There should be 2 words underneath your signature. What does it say? Authorized signature. All it's asking is, are you the person whose name's on a credit card? It's not, you're not promising to pay anything back. That's not what your signature is. Your signature is, yes, this is my card. I am the person who owns this card. You'd have to ask the banks that issue debit cards. I don't really know. Yeah. Legally, it's not, and that's what I'm talking about. Legally, it is not a promise to pay anything back.
It's an agreement to borrow, right?
Not,
But not pay back, but borrow. Isn't that the point?
your signing of that transaction only says that it's you. The actual arrangement you have with the company, the issuing credit card company, is what that represents, but your signature does not represent that. Yeah. Your signature on a promissory note, when you guys took out student loans, and I know everything's digital now, right? And you're just like, putting your initials or doing the digital signature. When you sign that document, you are saying, I promise to pay this back. That is a legal obligation. I promise to pay this back 6 months after I graduate at this rate of interest. That is a different thing. So, longer duration, there's always interest attached to it, more legal repercussions if you don't pay these back. If you don't pay back your student loan, you can say bye-bye to your tax return refund if you're getting one, because they'll snatch that right up. The IRS will know. Ooh, I can't wait to get my tax return. Oh, I didn't pay my student loan payment. I guess I'm not getting a tax return. That's exactly what that means. You don't pay your credit card. Yes, they send you letters. Yes, they get the nasty grams. Yes, they'll say they'll turn you over to collection. But theoretically speaking, how do credit card companies make up for people that don't pay their credit card bills? Interest rates go up for other people that actually do pay their credit card bills. And so if you were to go, if you were to file for bankruptcy, which of these do you think take precedence in trying to figure out what bills you can pay back? Yeah, the trade note. So what a bankruptcy court will do is they'll take your income and they'll say, okay, you have this much money. So your money, a certain they can only take a certain percentage of your money to pay off all the debts, right? If you're filing for bankruptcy, and then they rank your debt. And so you start at the top, and it's mortgages because people need a place to live. Utilities are up there. Child support payments. I'm trying to remember. Student loan payments, those are going to be your primary debts that are going to get paid first. And then everything else. And where do you suppose your credit card bill falls? Way down here. There's probably not going to be enough money that you got coming in to pay off all those debts. Obviously, you wouldn't be filing for bankruptcy if there were, right? And so you kind of got to think of the legalistic aspects that kind of go along with these. So this is an example. I like to show you guys examples here. These are in the textbook too, of what the excerpt from a balance sheet might look like. This is General Mills. What does General Mills make? Cereals. Yeah, that's what we most affiliate with General Mills, right? And so they've got accounts payable, and these are in millions of dollars as well. They've got long-term debt. They've got notes payable and current portion of long-term debt, and then they got other current liabilities. So and do I know if that's good, bad, or indifferent? I don't, because I don't really know what the average is for their industry. I'd have to look that up, right? So this isn't about, ooh, that's terrible, or this is pretty good. I don't know that from just looking at that. It's just demonstrating what it looks like in the financial statements. Here is the note that specifically explains or describes what the note payable components are made up of. And they use a weighted average interest rate. We certainly won't get into that, but commercial paper, and then financial institutions. And we're going to talk about commercial paper in this chapter, so we'll talk more about that and the differences between that and financial institutions. What do you notice? Let me just ask you a question from your, observe what you see here and tell me what is the stark difference between a U.S. commercial paper, which is a form of borrowing, and borrowing from just regular financial institutions like your local bank. The interest rate is much lower. You see that? That is actually the idea behind commercial paper, okay? Got a lot lower interest rate there. And then here's a little excerpt too. It says, to ensure availability of funds, we maintain bank credit lines and have commercial paper programs available to us in the United States and Europe. We also have uncommitted and asset-backed credit lines that support our foreign operations. Following table details the fee paid, committed, and uncommitted credit lines we had available. So these are all about credit lines. And can somebody expand without us getting into necessarily the details of this? And it says to ensure availability of funds, right? So why do you suppose banks need credit lines? Well, first of all, tell me what a credit line is. And if you could use it in the example of an individual like me or you, why would this be helpful to us? It's a credit line.
Pay for something with money you have now, pay back.
Yeah, so businesses often go through periods or seasons, right? We talk about that all the time. Yes? Ski resorts, are they real happy this winter? Probably not. We didn't get a whole lot of snow. It hasn't been real cold. But they'll make their own snow and they'll make do, right? But in their off seasons, they do have some revenue generating programs that they run. You can go hang out at the ski resort in the summer. There's little festivals and things like that and other things to do. But it's not the main months where they generate the majority of their revenue. So during those periods of low revenue, they still have to pay all their bills, right? You've got fixed costs that, remember, fixed costs. You still got to pay those whether or not you have revenue, whether or not you have sales. So during periods of time where you might not have the cash flow to pay your debts, you have what we call a line of credit. It's really just like this available amount sitting at a bank or some other financial institution as a backup. And you call up the bank and you say, if let's say you have a line of credit of $75,000, you can borrow up to $75,000 in any increments that you want. So it can be 5,000, it can be 50,000, it can be 74,000, it can be 75,000, up to that amount, and then you'll pay that back at a rate of interest. You don't, and what's the difference between that and going to the bank and getting a loan? Well, that's like something that's been prearranged. It's already sitting there waiting for me to have access to it. I have access to it anytime I want. If I borrow 30 of the 75, then I still have 45 left I could potentially borrow. I paid back the 30. Maybe I get down to 15 and I borrow another 20. It's kind of like a revolving thing. But I don't have to go to the bank and fill out an application every time I need to borrow money. It's sitting there waiting for me to borrow against it. It's a prearrangement, okay? And it's obviously necessary for businesses, particularly those that have cycles or seasons where cash flows, may not be great in certain months, and they borrow against those. I worked in an insurance agency for a number of years. We had a line of credit. We borrowed against it every December and paid it back every January. We had a little timing issue with when our big bulk of revenues came in. Our big bulk of revenues came in January, but our big payments went out in December because we paid bonuses and all that stuff out. So we had a little bit of a timing issue. We borrow against the line of credit in December to satisfy bonuses for salespeople. And then in January, when we got all of our premiums coming in, we pay back the loan with the premiums. That's how it works. All right, any questions? All right, short-term notes payable, some characteristics. Short-term, temporary financing, promissory note is signed. You guys know what all these things are already. Lower interest rates than long-term debt. Why? Less risky, better chance of paying it back.
People like liquidity, so they'll be willing to pay less.
Yeah, so there you go. Companies have flexibility while selecting alternatives. Here are some of the alternatives. We talked about commercial paper, just generally speaking, I don't really define it yet. Unsecured loans. What's an unsecured loan versus a secured loan? One has something, the other doesn't. They all have interest. Collateral. What is collateral? Yeah, some asset, right? Then you can say, hey, if I don't pay back my, oh my God, if I don't pay back my debt, you can come and take this, right? We talked about accounts receivable being used as collateral. Do you guys remember that back in Intermediate 1? That was so long ago. Yeah. And then credit lines, as I just explained to you. Now, within those credit lines, we've got formal and informal. You okay?
Yeah.
Are you sure? Do you need a napkin?
No, I'm good.
Okay.
Just
All right.
myself.
All right. Well, I don't know any kind of medical. I hope because I'd probably just stand here and watch you choke because the Heimlich. I haven't done that in a long time. Okay. Good thing we don't need to do the Heimlich one. Yeah, I am like the worst medical person ever. So just FYI. Okay. A line of credit is an arrangement to provide short-term financing. I already talked about that. So there are two types, committed, non-committed. This is more of a formal agreement, obviously, and you pay a commitment fee to the bank to keep a line available. So kind of open and access anytime, sort of the one like the one I was talking about. And then an informal agreement, you can borrow up to a prearranged amount without formal loan procedures, but you may be required to have what's called a compensating balance. So you got to keep a certain amount in the bank, just in case you were to borrow against one of these types of loans and you don't have the money to pay it back, then they take from your compensating balance. So it's a little bit of an insurance policy is how I like to refer to that. This is just a note showing you how it's disclosed. I'm not going to spend time on that. Let's get right down to the calculation of interest here, right? You got to pay interest. Money that you're borrowing from someone to use for your purposes when they could be using it for their own, it's not free. interest rate is the fee that is charged, right? It's usually stated in terms of an annual percentage rate of the face amount of the loan. And you guys know this already, don't you? Please tell me yes, right? The principal, which we also call the face amount, times the annual rate times the time to maturity. And the time to maturity prorates what number up there, if necessary? The third part of that calculation is really represents a proration of what variable? Not understand my question? The time to maturity. The annual rate is typically expressed, if this is 12%, I mean 12% for 12 months. But what if you don't borrow the money for 12 months? Do you want to pay 12 months of interest on some money you only had for 6 months? Say no. No. Definitely not, right? This time to maturity takes and prorates or converts the annual interest rate to an interest rate that represents the period of time that you have the money, if it's not for a full year. Theoretically, what is your time to maturity if you borrow the money for 1 year? 1. 12 out of 12, right? You get it? Because this is an annual rate. This would be 12 out of 12 if you were paying interest for a full year. Okay, just making sure we understand that. And we'll have an example here, and then you're going to do a couple for me. So we've got on May 1st, Affiliated Technologies, a consumer electronics firm, borrowed $700,000 cash from First Bank Corp under a non-committed short-term line of credit arrangement and issued a 6-month, 12% promissory note. Interest was payable at maturity. So we need 2 journal entries, one on May 1st, and what's 6 months from May 1st? You can just count months. You don't have to count days in this one. November 1st, right? Oh, for heaven's sakes, people. This is very basic. This is elementary accounting, right? You're doing the journal entries for Affiliated. They borrowed money. It's cash. A debit to cash, a credit to notes payable. Notes payable is a liability. All of our liabilities are credits, right? On November 1st, they're going to pay back the notes. They're going to pay back all $700,000. They're not going to just pay back $700,000. There is a fee for using someone else's money for 6 months. So look at the calculation for the interest, right? $700,000, since the 12% is an annual rate, you want to convert that to a 6-month rate by multiplying that by 6 over 12, and the amount of interest that you'll pay back in addition to the principal. So you guys have heard that principal and interest, right? Is $42,000, so your credit to cash is $742,000. That should, you guys should be like, that is super easy. Thank you. Okay, good. Then we have something called non-interest bearing notes. And let's take a look at what that means. So a non-interest bearing note is a note that basically discounts the interest at the beginning of the period. Guys, look up here at my screen. When did you pay the interest back on this one? Beginning of the period or end of the period? End. In a discounted note, where am I going? I'm going in the wrong direction. With a non-interest bearing note, you're going to discount the interest at the beginning. All right? But you still have to pay back how much? You borrowed $700,000, but it was a non-interest bearing note. So the lender took out the interest at the beginning and only gave you the difference between what you borrowed and the amount of interest that was charged. So your cash payment is less. The difference is basically interest, but why do we put it in an account called discount on notes payable? I need you to understand that part. Why is that? Because here's how this looks on the balance sheet. This is code for what? What was this in the previous example we just got done looking at? It was interest. Discount on notes payable, that's code for interest expense. But why can't I call it that?
Not interest.
It is interest. When am I allowed to record interest? Only after what has passed? On May 1st, if I were to say, forget it, right? Forget this. Do I technically owe any interest on May 1st? I really don't. I don't owe interest until time passes. Think about it. The reason I'm paying interest is for borrowing the money for a certain period of time. Okay? If I'm giving my interest payment to the lender, or if they're withholding it at the beginning of the loan period, I don't really owe it yet. Can't call it interest expense. This will get amortized throughout the life of the loan, and portions of the discount will become interest expense as time passes. Okay? So, look what happens 6 months from now, and because this is only one interest payment, it looks like this. This is a short-term note. If this was a long-term note, you would have every period, you'd have a little bit of amortization on that discount. But look what happens on November 1st. All of the interest that was called a discount is now being transferred to an interest expense account. Okay? And you're removing the discount on notes payable, and you're paying off the full value of the notes payable. The end result at the end of 6 months, isn't it the same as the previous arrangement? What's your interest expense at the end of 6 months? It's $42,000. How much did you pay back? $742,000, right? Well, you paid $700,000. $42,000 was withheld at the beginning. All right. The problem, it's not a problem. Why do you think a bank would do that? Because technically, you're paying a higher rate than the stated rate of the loan. So look how that works. If you take the $42,000, because you didn't get $700,000 in cash, did you? But that's how much you're paying back, right? You only got $658,000. If you take the 6 months of interest on the loan, which is 42, and you divide by the amount you borrowed, or that I shouldn't say borrowed, the amount you got in cash, which was only $658, you get 6.38%. That's for 6 months. If you double that to annualize it, you end up paying 12.76% interest. So those loans have a little bit of a higher interest rate than a loan that is not discounted and in which you pay the interest back at the end of the period. So we already talked about, I'm going to skip over that. So let's take a look at commercial paper here. So a couple things about commercial paper. The journal entries work very similarly to what you just saw. The thing with commercial paper is that there are certain characteristics and criteria that you'll see up here. These are unsecured notes, meaning there's no what assigned to them. There's no collateral. They are sold in minimum denominations of $25,000. You have to borrow at least $25,000, and they are very short-term in nature. They have a maturity period of 1 to 270 days, which is basically 9 months or less. Okay. They are usually loans between companies that are affiliated somehow. It's like you borrowing money from your parents. Let's think of it that way. And let's say your parents are like, you know what, I'm willing to loan you the money. I don't want you to go to the bank. The interest rates are too high, but you got to pay me back 2% interest or something like that. How about that? Your parents still want interest, but it's only a little bit, okay? It's like that. So it's like if you were to go to your parent and they were to offer you a little bit of a better arrangement than the bank. I'm not going to spend time on these disclosures. You guys can read those. You should read those. And let's see. I'm going to have you guys take a look at a couple of brief exercises here real quickly. So let me find my book here. All right. So let's take a look at exercise 1-3. Oh, all these are good. Okay, 1, 3, 4, and 5. See the highlighted ones? All right, I'm gonna give you about 10 minutes. We'll have you work on those. Come on, you can do it. And that's how we'll wrap today up. That'll be a good place for me to stop. 1, 3, 4, and 5, the highlighted ones. They're all basically deal with some kind of loan arrangement. So 13.1, Eater Fabrication borrowed $60 million, issued a 9-month promissory note. Interest was payable at maturity, so not discounted at the beginning. Prepare the journal entry for the issuance of the note and the appropriate adjusting entry for the note at December 31st, the end of the reporting period. You're not actually paying back the note at 9 months, but something happens between October 1st and December 31st. So we'll see how you handle that. You guys should know that, but we'll see. Exercise 3.3. This is just asking for amounts of interest. There's no journal entry with exercise 3.3. I'm going to go over these, so I want you to do them now. 3.4 is commercial paper. We want the journal entry of the issuance and then the repayment at maturity. And then brief exercise 5 is all about that non-interest bearing note, the one I just showed you an example of. So if you have to pull up the slides on your laptop, you can do that. Excuse me. You are welcome to do that, but we're going to look at this. What week is this? 6, right? How we doing? All right, let's make sure we get through all these so you guys have the solutions here. So, first one, on October 1st, Either Fabrication borrowed $60 million and issued a 9-month, 12% promissory note. Interest was payable at maturity. Okay, right? So tell me, before I do anything, I like to draw. No, I don't, but just thought I'd say that. I'm going to draw a timeline here. And I can draw a line. And this is October 1st, right? When is the note due? Give me a date, just 9 months from October 1. So November, December, January, February, March, April, May, June, July, July 1, we'll say July 1, okay? We're not counting the actual days in the month, right? We'll just assume all months have 30 days for the simplicity. What happens in between here, though? That's pretty important. Ian. The end of the year, which is December 31st. Okay, everybody watching? And December 31st is when all the magic happens, right? We do our closings, we do our financial statements, we wrap it up, and we start all over again. Okay, so this is when we borrowed it, right? This is when we'll repay the money. However, interest is the fee that we are charged for the use of the funds. Did we have the use of the funds from October to December? Yes. How many months? 3 months. Okay. Technically, we have a liability on December 31st. We owe the bank money for 3 months worth of interest, right? Even though we're not going to pay back the interest until when? Yeah. So on October 1st, we debit cash, right? And we credit notes payable for 60 million, sorry, right? Yes? Okay. On December 31st, we've got a journal entry for interest expense, interest what? Payable. How much? 1.8 million? How'd you get that? Correct. You with me? Maybe? When I go to, I know this isn't part of the question, but I'm asking it anyway. What's my journal entry look like on July 1st? There are 3 things I got to manage here for debits. What are they? Okay, notes payable. We'll get rid of the easy one first. There's no discount, right? What liability am I satisfying on July 1st that I incurred on December 31st? Yeah, what liability am I satisfying on July 1 that I incurred on December 31st? Interest payable. And what do I also owe for the next, how many months? 6. See, my interest expense has to total what? My interest expense has to total how many months? 9 months. 3 months of that was in 1 year though, and the other 6 months was in another year. So what's my interest expense for the current year? Well, what's 60 million times 12%? times 9 over 12. 5 is it 5.4? So my credit to cash is going to be this is elementary accounting, guys. You need to know how to do this stuff. You should know how to do this. This is basic debits and credits and understanding interest. Does that make sense? Now, exercise 3. All you had to do was calculate the interest. So, on July 1, Orcus Labs issued a $100,000 12% 8-month note. Interest is payable at maturity. What is the amount of interest expense that should be recorded as a year-end adjusting entry? Well, look, I already gave you what the entry is. It's a debit to interest expense, a credit to interest payable. You just have to figure out the amount. And then what is the amount of interest on September 30th? So no journal entries, just figuring out how to break the interest up. So if you were looking at July 1 as the issue date, and you're talking about an 8-month note, how many months pass from July 1 to December 31? Do it. I don't care if you have to count it out loud. Don't sit here and go, all of July, because it's July 1, right? August, September, October, November, all of December, December 31st. So it's what? 6 months in 1 year, and then the other 2, right? Does it say 8 months? Okay. So you just need 2 calculations here, right? $100,000 times 12% times 6 over 12, and $100,000 times 12% times 2 over 12. Right? Are we looking at that correctly? It says 8-month note, yes? I think it should be August then, not September, the way it's listed there. So this is either supposed to be a 9-month note, or that should be August 31st. We'll keep it with 8 months, but you guys good with that? And what do you get there? You get 6,000 and 3,000? 2,000. Hold on. I don't know, I didn't do it, hold on. Yeah, 2,000, right. Questions on that one? No? What about number 4? Wang Corporation issued $12 million of commercial paper on March the 1st on a 9-month note. Interest was discounted at the issuance at a 9% discount rate. Prepare the journal entry for the issuance and then the repayment. So in this one, you have a discount on the notes payable, do you not? You do. So here's what you should have come up with, because I'm going to run out of time here. Why is your cash only $11,190,000? Because the lender is keeping the interest from the $12 million at the issuance date. Right? So 12 million times 9% times 9 over 12. It's a 9-month note, right? So the interest is $810,000. You cannot call that interest expense on the date of the issuance. Why not? Oh, this is going to be a question on the test. Why am I calling it discount and not interest expense? Because that's really what it is. Luke shrugs his shoulders as if he hasn't heard this before. Didn't I just say it like 20 minutes ago? What is it? Has time passed yet? Can I call it interest expense if time has not passed? I cannot. I don't actually owe any interest on that date. So we put it in a temporary account called discount.
Sorry. The second part of the last question, why is it not 3 over 12?
It said it was an 8-month note.
If it's from July 1st to September.
Yeah, and I said one of those dates, I said one of those is wrong. The date might be wrong.
Sorry,
Hmm?
I must.
Which year would September be considered in that?
Well,
Is it considered in the same year that
I thought July, August, September,
Yeah.
and then 3,000. So that's why I look so confused.
Oh,
Okay.
well, I really wasn't. It's just, it should have been 8 months total.
Okay.
So, like, as far as the dates go, something is wrong in the problem with one of the months they're identifying. Right? So when was the note issued?
I didn't think it had to be 8 months total. That's why I was.
It said it's an 8-month note, right?
Yeah.
Yeah. So the two different interest payments. So when was it issued?
July 1st.
Right. So July 1st to December is 6 months, right?
Uh-huh.
I don't know where they're getting the next date.
Are they ending that fiscal year in September of that same?
It doesn't say that. That's the thing, it doesn't say that, because we're using December 31st. If that was the case, that December 31st isn't the end of their fiscal year, then why are we doing the problem? You know what I mean? I think there's a mistake with the September date. That's my point. I don't think that September date's right. It's an 8-month note. 6 months interest belong in one period, 2 months belong in the other period, that's all. Ignore the months, the names of the months, because something is wrong in the problem. Back to this problem. Does everybody understand why we're debiting discount on notes payable for $810,000? We borrowed $12 million, but the lender said, we want our interest today. The day that we're loaning this money, so we're only gonna give you $11,190,000 cash. So they withhold the interest at the beginning of the note. Can't call it interest expense though, because no time has passed. I don't owe it yet. At the end of the period, I transfer all of the discount and I put it in the interest expense account, because now time has passed and I can call it interest expense. And I pay back the note at the face value. See, I'm paying back more than the amount of cash that I got originally. That's why my interest rate is going to be higher for this one. You guys do 5 for Tuesday. Because exercise 5 is similar, but it asks another question. Now let me go back to 3 here. Yes, dear.
Can I see the answer to number 1 again?
Yeah.
Red socks, that's my red today.
Thank you.
Yeah, see, it says July 1. 12% 8-month note.
Yeah, but if you read the last sentence, it's giving you like 2 different fiscal year ends. So it's like 2 entirely different days.
Oh, so I read it wrong. So
So it would be, the first one is
July.
6 months and
July
the second one is
is
3
3
months.
months.
Yeah.
yeah, I wasn't reading it like that. I read it 6 times and I didn't read it like that
Yeah.
way.
That's why I
Yeah,
was,
you're right.
I was
Okay,
looking at the board
I'll
really
mention it. I was like,
confused.
what are you guys talking about? So if the fiscal year, 2 different fiscal years. Do you know how many times I read that problem and I didn't catch that?
Dr. Sedow,
Yes,
my
dear.
question for 13.1 is how do you get both of these debits on the same journal entry?
Because this is, the the first part of the interest expense, the first 3 months belongs in this year.
Yeah.
That's the key part. You're not making a payment though on December 31st of interest. So the interest payable for that piece of interest is going to get paid on July 1st when the rest of the interest is going to get paid. But a portion of it is an expense that belongs in the first 3 months, or this first fiscal year, right? And then, so you got 1.8, and then interest expense, the other 6 months of interest belong in the same period as when the interest, or when the loan's getting paid back.
Oh, I think that number is slightly too high then.
What number?
I think that shouldn't you subtract 5.4 minus 1.8?
Is it too much?
I think so, because
Did I do?
I was so confused
I
the
had-
last 10 minutes.
I had 65.4 million for
Okay,
total.
hold on.
I'm
I said 5.4 and somebody said yes, because I was trying to do the math in my head.
Yeah, that was me that said yes for the
Oh.
total, but I didn't know that both.
So hold on a second. So 60 times, this is what happens when I hurry. This is my fault. Oh. Is this a 9-month note or a 6-month, or, yeah,
This is 9.
yeah, so this should be 6, right?
Ah.
That's why. And I did 9 months, so you're right. So now I'm gonna have to go over all this again on Tuesday because I rushed through it. Damn it. That's my fault. All right.
I'll see you
So,
tomorrow.
See ya.
Sounds good, thank you.
No, I'm glad you asked. That's 3.6.
Yes, it should, it should equal, I think, 5.4.
Yeah, so 5,
65.
65.4 is what it should be.
Thank you.
Oh, for God's sakes. Okay. Now, if I didn't screw everybody up there, how about